Let's preface this meeting down to like rewriting the rules, entrepreneurship, finance, and AI in the Great Awakening. So let's start with trying to define what I mean when I say the Great Awakening. And like any good attorney I've learned, it's the good thing is let's get on the same terms. So the old rules of business are crumbling beneath our feet. Now what banks denying 80% of small business loan applications, and venture capital, it's a club that funds just 1% of entrepreneurs. If you're waiting for a seat at their table, you just might starve. But here's the truth. We don't need their table. We're building our own.
First, a quick word from our sponsor.
I couldn't give anything a higher endorsement.
I would be remiss had I not include 𝘠𝑎RDIO on my very short list of secrets.
It's the real deal. It's a real product. It's not another supplement.
I'm operating about 6 to 8 hours, and I've noticed that being on this 𝘠𝑎RDIO has made a huge difference.
Since I started taking 𝘠𝑎RDIO, I'm about 8 months into it. The benefits have been fantastic.
If I get hungry, then I just have a 𝘠𝑎RDIO.
I encourage you to take this seriously because it's not only about your athletic performance, it's about the general health long term.
Not only is it safe, but it's necessary to take 𝘠𝑎RDIO to stay well.
This let me sleep. It's filling up more energy, more get up and go. And it's all because of what this company does.
For me as a doctor, 𝘠𝑎RDIO is a staple.
𝘠𝑎RDIO to me is hope in a glass.
Welcome, everyone. It is Thursday, time for the Freedom Hub Working Group podcast. Got a good show for you today as we wrap up the year. Before we get started, though, if you are new to the channel, let me show you our website so you know where to get information, who's coming, who's going, etc., etc. And here's our screen share. Go to your-mp.com, that stands for yourmarketplace.com, and you'll click over on the Your Media Hub tab, if it's working. Yep. And you'll see our Wednesday and Thursday show. We have the Health, Biz, and Politics and today's Freedom Hub show. We do recommend you subscribe to both because there's a lot of overlap. And if you definitely want to think of out of the box, that's Thursday's show. So you'll see our speakers, the topics, who's coming up. We have a holiday break next week, of course. And then the channels where we post these on the following week: BitChute, Brighteon, Rumble, Tubi. It's kind of new. And not much on YouTube, maybe today, but they censor us a lot. They were, so we don't like them. And that's about it. Let me stop the share and turn it over to you, Charlie, to introduce our guest and the topic today.
Thanks, Jim, and welcome, folks, especially regulars. This is our final Freedom Hub show of 2024, and as usual, soon over the break, I'll Substack the most viewed shows so we can see what you guys like, based on views at least. And when you say Tubi, I still haven't gone there. One of us should actually show that website here and help folks become brave to check it out, because I haven't. I'm still a Rumble person. It's just the easy default. To set the real quick context for today's show, for some reason, I got a bunch of interviews over the past year. A bunch of folks interviewed me. And one of those was our guest. Here's one of the recent interviews. I guess being a lobbyist for health freedom and making cash patients is big these days for good reasons. And it was Full-Time Hustler right here. That is Jason Feimster's show. I got interviewed also by Joel Salatin, who's going to be our health freedom hero at the agriculture department. Marilyn Singleton over at AAPS died. So if any of you knew her, she was such an icon for health freedom. Robert Scott Bell, who will be on my NHF show tomorrow, and the holistic pharmacist Sean Needham. When you go to this link, you get to this interview here, where Jason and I had a real long discussion, and he always has been an intriguing fellow for me. I met him on the Libertarian presidential campaign of Governor Gary Johnson that I helped run, and he's a Marine, and he is an angel investor helping startups. And this is today's alert that I put in chat that you can open and follow along. You'll see the recording from last week's show. And let me stop there. Jason uses a lot of artificial intelligence in his work, and he's going to talk about that as part of an advisor for startups. And we also set up today's show to be for those disruptors who want to work in a way that does good for society, for a good cause, help the Great Awakening. So Jason, take it away.
Well, thank you, and nice to meet everyone. To kind of give a quick introduction to give context more to Charles's introduction. For the last 14 years, as he alluded, and as the logo on the hat says, I fell out of the Marine Corps about 14 years ago, and didn't know what I was going to do, but I know I didn't want to be broke, so that led me to an inclination to go towards finance. From there, I came in, what I've been told in hindsight is backwards, because I came into this door through someone that was looking and that was nice enough to take me under their arm, an investor at the time and I came in through what the VC and private equity side, which again, I've been told that that's the backwards way to come into finance. But nonetheless, that's how I came in. And in those 14 years at the start, essentially I was a lackey trying to find great startups for the fund that we could invest. And in that period, what I've discovered is two things, one internally and one externally. The internal one is I am a yes man. I do not like to say no. However, professionally in this field, I got to say no. Looking at my own data, and in hindsight, it was 99% of the time. So despite not being a yes man, or despite being a yes man, I was saying no a lot because of the opportunities for various reasons, whether startups were not ready, were not suited for our fund. But again, it's very hard, even when you're in a position like I was at the time, actively looking for startups and spending the effort behind that. It's still not easy to find ones that you can actually deploy capital. So that led me from that side of finance ultimately to come to the other side of finance, which is the way I'm going to preface it for right now, is there's two sides. There is the equity, and then there will be the debt side. So essentially what I did is I crossed, not officially, but I started working with lenders on the side, if you will, kind of my own side hustle, to ultimately say yes to the startups that I'm saying no to. So, that's a verbose way of really explaining that if you're coming to our fund and you're pitching for an equity investment, say, hey, I want $500,000 for 20% of your company, and we end up saying no, which, as I stated, we say 99% of the time. At least I then can say, hey, well, here is, I didn't know the word affiliate marketer there, but I was like, here's an affiliate partner. Of course, I didn't know that then, but ultimately, again, I'm like, hey, here's this lender on the other side of, again, on the other side of financing. I know that may not be what you're looking for. And speed that up to present, what is culminated in now what is one of the pioneer brand, or the Apex brand, which is Moonshine Capital, which is essentially became a marketplace. And ultimately, it's just a culmination of the network that I built, over 14 years on both sides of finance, primarily spending my daytime, if you will, in the equity and private VC, trying to find hyper deep tech, type SaaS solutions, but yet still being able to say yes, or at least by way of referral, to many of these other referrals and alternative, what has become what I've learned in, alternative finance with the help of now fintech type applications, which is where the AI will come into. So that's what is really culminated now is these unknown direction that I was going in out of the Marine Corps, in this becoming hyper focused in private equity and VC, which is hyper focused in and of itself, and then working out, trying to get relationships with people like Charles and others, and through networking to build out beyond the other finance companies that can lend beyond myself. and what that has become. So if I can pull up here for a second, I will pull up. That's just kind of a background, and I only say everything I'm just saying there was just in context to kind of give a framework from everything that's about to be said is coming from this. I kind of stumbled into the finance, and here we are. I'm saying no all the time. I'm miserable, but I'm working with amazing people. So how can we fund these amazing the bulk, again, the 99% of the other companies? And again, that's where AI is. That is where Moonshine Capital is now. Another brand I'm affiliated with that, again, the facilitated part of this is, as you see there with Charles reference, is Full-Time Hustler, which is really a content marketing agency. It really what they were doing at the inception was creating the content for a lot of finance companies and connecting them with, if you will, the influencers that would put great products and great fintech products into the hands that could use it the most. So that's where these have come to, and where we are now is we are operating at the cutting edge. And the last year we've stood up a FinOps as a service company, which is really a lot of AI automation for financial operations for a lot of these companies that whether they get invested through debt or whether they get invested through an equity fund, we can automate a lot of the finances because, as I'll allude to in this script that I'm about to follow, if I can get to it and stop ad-libbing, a lot of the reasons, again, why we say no, it comes down to kind of 2 or 3 general reasons. And one of those reasons being a lot of the times startups fail is not because they lack money. And I hate that saying. I want it because, again, coming from both sides of finance, I can say there's always money. And if there's a sound bite to take from this, to say that a company fails for money is, quite frankly, BS. And I'll stop. And I don't know the vulgarity on this, but it's worth the word. In that, whether you build up credit, we can get into these in a minute, different options that I've came across, whether again but specifically on the equity side, you're getting denied because you don't know your cash flow. It's not that you don't have money. You're not getting funded because you're not monitoring your cash flow. So again, when I say that we got a fintech operations now as a service, kind of one of our budding companies that we have internally. It's so for these companies, whether they're taking a loan, whether they're taking revenue based, or whether we're giving them an equity investment, so you need a very tight handle on your cash flow. That's the lifeblood of your business, and so many entrepreneurs really don't. And just to give a kind of a backtail example, and then again I'll stop this verbose ad-libbing. Where I disagree with a business fails for lack of money. I know that's a top-sided reason, but again, you need to dig down deeper. It's not the lack of money. It's, for example, right now anyone could come to Moonshine Capital if you have because the 3 C's, whether it's equity or debt that we go by, that I've learned in these 14 years, whether it's, again, the equity fund or the lending marketplace, is 3 C's: credit, collateral, cash flow. If you bring one of those, and obviously a lot of the equity deals with the cash flow, that is when they say that, you don't have enough proof, or you need more evidence. Right now, bring just credit. If anyone has a personal credit, 650 and above, pretty much you can get a 100% zero interest business credit, not counting what you can get term loans based off. Now, I'm not suggesting that those are the right forms of funding for whatever the particular business is. I'm just simply highlighting at the inception of this introduction that the lack of money is one of the banes of my existence, even despite saying the no. So now I'll switch from the ad-lib. Again, that's kind of a long-winded introduction, kind of a background. I hope something of that is of value. If not, I'm going to read kind of I elected not to share presentation because there's so many. I'm affiliated with so many companies directly and indirectly that it's like, well, which one do I really want to sell on this? Or which one do I want to advocate, sell, or whatever in this meeting? And it's like, none of them. Because I'm not really here for it to sell. I'm not really here to advocate for any one of them. I'm kind of giving, this overall general topic, which today I'm going to preface that topic as the meeting came out. And I'll start with kind of an opening hook and I hope that and I want to try to define, the opening goal here is to define what I mean when I say the Great Awakening. And because that's kind of an abstract in of itself, even though, again, I'm talking multivariable topics on today's meeting. The Great Awakening in and of itself is the start, which, again, let's preface this meeting down to rewriting the rules, entrepreneurship, finance, and AI, and the Great Awakening. So let's start with trying to define what I mean when I say the Great Awakening. And like any good attorney I've learned, it's the good thing is let's get on the same terms. So the old rules of business are crumbling beneath our feet. Now what banks denying 80% of small business loan applications, and venture capital, it's a club that funds just 1% of entrepreneurs. If you're waiting for a seat at their table, you just might starve. But here's the truth. We don't need their table. We're building our own. And I hope that introduction kind of gave a little foreshadowing of where I'm going. But this is the Great Awakening of finance and entrepreneurship. It's a shift driven by those of us tired of the gatekeepers, the bureaucracy, and the systems designed to keep us playing small. One example, before I go further, is if you don't take credit, and I use that of the credit, cash flow, and collateral, the big 3 C's in finance, that everything else is a derivative thereof. Just take credit. If you don't believe it's actually aimed against you, I would challenge you by asking a simple question. What do you think credit bureaus are? They're not here. They're vested to keep reports or keep negative items on your report. They have no place if you have great credit, other than to just say you have great credit, and I guess being this third party independent, kind of like Fed Reserve type agency. But other than that, their existence in and of itself facilitates to keep you down, as the mantra goes. And that they only exist, again, they want you to have bad. And there's a long list of things you can do to fight if you wanted to fix your credit. If that was that's not necessarily my expertise, but obviously I've ran across it. People trying to get financing and they want to do it based off personal financing. First, go tell the credit companies, have they verified that debt that's on your credit? Simple that I did not ask if the debt was yours. And again, we're zooming in on one particular type right here at the beginning, and that's just personal credit. And that's a very small aspect of what I've done, but I'm just trying to demonstrate that, yes, the system is against you. And when I ask someone, all right, here's an item on your report, it's reporting, I see your credit report, I see an item on here, is that accurate? Now, I'm not asking them if that's their debt. What I'm asking is much more important. There's a congressional act that credit bureaus, personal credit bureaus, and it's different for business, which is really where things get really fun. They have to verify every time they change hands. Every time they change hands, before they put that on your credit report, they have to verify that, hey, this is so-and-so who they say they are, and this is their debt. And we know that if you were and for those that have been in a situation where they've had a bad debt, it changes hands. It sells faster than you could blink. Are those bureaus that are the credit companies that are reporting this? Are they verifying that each time? No, that's the problem. They have a congressional obligation. You don't. Now, again, I want to be for those that are going to listen to this later on, and I know this will be on the World Wide Web, I'm not saying I want you to default on debt, but what I'm saying is, as the Marine, I fought for your right of the Fifth Amendment, and you should use it. Just shut up. You don't have an obligation. Your obligation is to make them verify, and a lot of the times they can't. That's more important. That's more incriminating. So if you have a terrible credit record, let's say you were going to start a business and I was offering you $100,000 loan, but you've got poor credit. The first thing, let's look at this credit and say, hey, wait a second. Again, I'm not asking you to say yes or no. I don't want you to admit fault. What I'm saying is, have the credit bureaus, who again have the obligation, have they reported it? Now, I don't want to dive too far. I think that's been enough on personal credit, but it starts with this opening sentence that we are the system at large. And it's not necessarily, I don't want to think it's malicious, it wasn't, but it does turn out in the way that we live, and that financial distress, and that it is against you. We are down. So that's what we're trying to tear down, these barriers. And I say we, and I mean the collective that I've became a part of, and the many ventures from the equity side, from the debt side, and now this new fintech AI, agency that we're spinning up. That's, I say we, but I also mean the larger market which we serve, which is again this middle market, this chasm between someone that can get a great idea and get some initial traction, but they can't get enough traction to qualify for what I would have said would have been yes to the 1%. So it's like, that's the 80%. That's the bulk of businesses. They don't qualify for equity right out the gate, and banks are saying no to 80% of them. So it's, again, that's what I say the we. I say the we directly in the companies that I've referenced, the 3 that I'm a part of directly, and again that market that we're really serving, that middle market that is underserved, again, and that's a large audience. You're either a unicorn right out the gate, or there's a very slim chance you'll get funding even with the best options. I mean, and there's a whole nother, equity. It's a lot of reasons in that, we'll dive into, what we're looking for on equity. And then from the lending side, it's just so risk averse. And so banking is so regulated that they almost say no even when they want to say yes. In fact, the number one concern in banking is not fraud. It's actually, it's not default, it's fraud. And what that has to do with somebody applying, and I'll share a case study here in a minute, a company that's making $100,000 a month. So I'm really trying to paint a picture that when I say this 80% is getting denied specifically over here on the debt side, don't think a person with bad credit, even though that's how I started this story in the exact terrible way. But that's not who I'm describing to you. The 80% are great small businesses, mom and pops that you probably shop at every day. And the bank that they've been at for 20 years can still tell them no. And this is what I mean by how regulated, and I'm only giving one kind of devil's advocate out for the banking, try to explain why, but not necessarily saying I agree. The financial industry at large really shares a database. So any application that you've ever filled out ever in your life, we have access. If you go to, and a lot, at least on the debt side, say you're trying to get a consumer credit card or a business loan or whatever it may be, and you try to go to Wells Fargo, but you think you're going to get smart and slide over here across the street to another bank and fill out the same application and try to get two loans or whatever. We get one credit card at Wells Fargo and one loan at JPMorgan Chase at the same time. But in the process, in your middle name, let's say your middle name starts with a T, and you put your first name, your middle initial, and your last name on one application, and on the next application, you left off the middle initial. Now, I want you to go back to what I think about what I've just previously said, and that the biggest risk in the financial industry, specifically to the alt finance and at larger banking and debt, is fraud. It's not default. So they spend more time in fraud. And so how can Wells Fargo, when they have 10,000 applications every minute, verify that that's the same person? Well, I can give you the answer. They don't. Denied. So that's a practical example of what I'm describing of the 80% of the market. Right now, half the people on this phone, by law of statistics and the numbers, if there's 10 on this phone, 8 of them cannot get, and it has nothing, will not get approved through regular finance channels. And if they have a startup venture, then we can get into they'll qualify it out the gate, depending, without any other merits of the business. 1% if they decided to just skip banking and lending altogether and go to the equity. So it's like, those aren't good odds. It's like right out even a good person, again, the example I was going to give is a company I've worked with. They were making $100,000 monthly, been in business, been with a certain bank, and I don't want to throw this bank under, but I will give an example. They were with Chase. Not that I'm picking on Chase. Again, this is all banking and just the regulation that they face. They made $100,000 a month solid, and they're 50% type margin. So again, a very cash positive business, and they were looking to expand. Been with this bank for 20 years, and they were denied because of the industry they were in. They were in construction business, and right now they're going through a crux. Again, as regulation cramps down even more so in the time that we live in, becomes even worse. These outlying type businesses, these businesses that actually rely heavily on cash. For example, I just gave one, construction industry, heavily cash focused. I mean, you need cash intensive up front. But even if you get into the tech world, and a lot of our companies with Moonshine Capital are e-commerce. Well, as you see right now is the holidays. Well, they were ramping up, financially speaking, if they were smart. Again, back to that cash flow that a lot of them don't do at the inception. You should have been projecting to buy your inventory in October, November, whatever their cycle may be, but to sell the products that we're now buying for our holiday season. So even in the tech world, we're not past that cyclical nature of there will be heavy capital intensive periods in your business. So again, this is the Great Awakening I'm talking about. People like that I'm describing, and if this resonates, if this convoluted description I'm giving resonates with anyone, then you're already part of this Great Awakening. So we're breaking down these rules, and we can get into that, and I hope some of these questions will help carry that forward. So again, as a personal introduction, though Charles already did, again, I'm Jason Feimster. I'm not a banker. I'm a VC, or as you can see, a suit and tie wearing financial guru. I'm a Marine that stumbled into finance and has been making my way ever since. Very successful, great fun from the equity world, great mentors, great partners, and then built a network over the next 14 years on the debt side with over 140 different finance companies, ultimately say yes to the people that I was trying to say no to. And that became the marketplace that we are. So that's where we currently are. That's me, background, where we're at. So let me ask you, Now, if you were starting a business, what would be holding you back right now? Is it capital, or is it clarity, or is it the belief that you deserve to play this game on your terms? And whatever that is, I promise you, I hope by the end of this session, you'll be ready to take that first step. And whether developing the business itself, whether that's to go to the equity, or whether that's to know what you need to qualify for business, or in the third case, to actually get the tools to automate to make you a financially solvent company, to give you the information as the founder and saying, hey, here's how we can open a bank account. Here's how we can automate business credit. Here's how a lot of this, again, can be automated. It's just entrepreneurs don't know. Again, another example of that would be like 0%. I hope anyone here that's half financial savvy can understand when I say 0%, you can't beat that, and equity in the bank can't beat that. But who can is business credit cards, ones that write lines. Why? Because they're not making money on the interest, they're making money on the processing. So they can give you 0% for say 18, 20 months on your business. Well, that's 100 grand, 250,000, depending on the business, not personal. So it's like, again, back to a previous point, don't tell me that you don't have money. Now, the problem with that is you have to incorporate your EIN, you have to have a business bank account, you have to use vendors, which is the very first step, again, automated. They only qualify tier 1 vendors that only qualify you based off your EIN, which you just incorporated this morning. Will give pay net 30, do 3 of them for 3 months, you automatically qualify for tier 2. My point I'm trying to express is this very simple process, but no one does it. And unlike personal credit, business credit is not automated. But it's like if you did that within 6 months, you'd qualify for 100,000 business credit line, which is a tier 3 and a tier 4. But again, tier 1 and tier 2 is automated. You just have to have ones that report to the business credit bureaus, which is, I guess, the hard part. But it's just, we don't know that. A lot of entrepreneurs don't even know they exist. But again, to tell you that 6 months from where anyone stands, if they incorporated tomorrow, they can still get 100,000 up to about on average 100, depending on what vendor you're going to, what company you're going to, $100,000 line, 0% interest for 20 months. And I challenge that if they're business minded, that, hey, if you can't turn a profit in 20 months, then don't take this, don't even start. Like, what are we talking about? This is supposed to be a business funding, but it's like 0% interest for 20 months. So again, I hope that adds further clarity to a previous point that lack of money is not the problem. Again, it's more of this, we're not told that, again, we're not told anything about business credit. We're not told, and personal credit, as you can see, the credit bureaus exist to report and keep you down. And I hope as we transition, talk more about the startups, kind of what we're looking for, and kind of the chasm that, again, from funding, from investors, whether that be angel investors or larger VC funds, what they're looking for and where, again, the gap becomes. So let's start with a truth most people don't like to admit, and that is, and again, as we've concluded, that, well, I hope I've made it somewhat clear, that the system is not built to serve everyone. It's a rigged game. It's designed to reward the safe bets and shut out the rule breakers, which is unfortunate, because unfortunately the marketing is the exact opposite. Let's take the unicorns and let's, everybody be innovative. Well, that's actually not the way it goes. In fact, my experience on both sides, whether it's debt or lending, finance at large, is it completely risk averse. And that's personal token. Take that for what it's worth. But again, VCs, they're investing less than 1% of these startups, and banks, they're denying most of the people. So if you've ever felt like you're shouting into the void, trying to get funding for your idea, and anyone here, if you've ever experienced funding, whether again it be a loan or whether it be an equity investment, it's because the system was designed to ignore you. And the worst part, they tell you it's your fault. That's your business isn't viable, or you didn't try hard enough. But the truth is, the rules were written to keep most of us out. So let's break it down. Traditional finance is full of barriers, strict credit requirements, lengthy approval processes, collateral demands, and a prove yourself mindset that favors established players over emerging ones. And that's clear across the board, despite the narrative that is the opposite of, we praise innovation. So, we praise innovation so long as it is low risk. There's that last disclaimer that never gets told. It's a game stacked in favor of those who already have wealth and access, and against those trying to build it. I remember working with an entrepreneur, and as I mentioned, with the construction company, who poured her soul into creating a unique product, had traction, real customers, solid revenue, like the previous example. But when she went to the bank, they told her she didn't have enough credit history. The irony, she didn't have credit history because she was busy building her business instead of taking out personal loans. the system punished her for doing exactly what entrepreneurs are supposed to do, which is focus on growth. This is why so many brilliant ideas never see the light of day. It's not because they weren't good enough. It's because they couldn't jump through the hoops of a system that was never designed for them in the first place. And that, my friends, is a tragedy. Not just for the entrepreneurs, but for the economy, for innovation, and for all of us who stand to benefit from their ideas. But here's the thing, we don't have to accept this broken system. There are other ways, better ways to access these resources we need to succeed. And this is the great awakening in finance, is about breaking free from these barriers and building something new, something better. And it starts with recognizing opportunities that are right in front of us. Now, let's talk about that. Let's talk about identifying promising opportunities. Let me ask you this. When you think about entrepreneurship, does your mind go straight to launching a shiny new startup? For many, that's the dream. But here's the thing, entrepreneurship is so much bigger than just starting from scratch. In today's economy, opportunities come in many forms. Acquiring businesses, which I am a huge fan of. Look at the boomers who have acquired the massive amount of wealth since post-World War II, and that wealth lies in the hands of largely one generation. The largest transfer of wealth is about to be underway. So all these people, again, and these Gen Xers and myself, millennials that are out here with their brand new, I've got the brand new way, the rabbit wheel, but it's like, wait a second, how many of these businesses are already existing that the owners are trying to exit? And you could buy a cash profitable business without paying pretty much anything based off financing I'm about to share with you. And that the business is already generating revenue. I know it's not sexy to own a plumbing company or a mom and pop, whatever the company may be, but I can give one example of a guy that started and again, a plumber. 10 years later, he was one of the first ones I did on the debt side. He owns 37 trucks and about 20 million a year, and he doesn't do any plumbing. He just essentially gets all the jobs and outsources it to, well, now his internal team. But that's how he grew. But the point is 20 million a year, because again, people are always going to be using the restroom and needing plumbing. So again, not sexy, but you could go buy that business right now with whether he would offer seller financing, whether I could offer you revenue-based financing. But again, the business has its own asset. It's, again, back to the 3 C's: cash flow, collateral, credit. It's got cash flow. That business can probably pay for itself. Whatever you bring to it, whatever the ad multiple is, we'll get into that later. And I hope that I'll save that for a second discussion. But it's like, again, we don't need to go reinvent the wheel. So I don't want to beat up those that are trying to innovate and start up brand new. I just want to point out that acquisition is a great phenomenon that I hope many more pay attention to equally, if not just a fraction of those that want to come up with something new in and of themselves. But also that can include launching side hustles, or in my case, what's happened over the last 14 years, micro businesses that they will organically grow or they don't. Either that's my own incompetence or I didn't, for whatever reason. But again, a micro business that maybe, 10,000 monthly MRR isn't anything that was, a bank would jump at, or definitely a VC wouldn't look at. But till 10,000 a month in my household was nice. It's a nice thing, So again, micro businesses. So again, that 3, you've got acquisitions, you've got the startups, you've got micro business and side hustles, and all of them, the goal that we want is to scale sustainably. And that is the key. And how you do that it's how you position yourself for success. So let's talk about these different paths of entrepreneurship. Again, acquisitions, as we alluded to, is instead of building from ground up, why not buy an existing business? With the right due diligence, you can inherit customers, systems, and cash flow. That last one is to not be taken lightly. So then you have obviously the second one, which obviously probably likely the first one you thought of, which is startup ideas, which is, yes, innovation is live and well, but the trick is validating your idea before you dive in. Like, who is your market? What is your problem? In fact, when I was on the equity side, my outline, it doesn't matter what you were pitching, I was going to ask you a boilerplate response, which was, what is the problem you're solving? What is, what is the solution that you've developed? Who are you developing that for? I.e., who's your market? How are you getting the message to them? I.e., your distribution, your marketing, your go-to-market. Like, how are you? But, again, essentially, problem, solution, competitive advantage, which is, I should add that one back in. That one's a key one, because again, what makes you different when the big companies become aware of you? Say you're halfway successful in proving your model, and the big companies get aware of what will stop them from blowing you off the map, and more particularly, what is the thing that your customers can only get from you? And to summarize 14 years from the equity side, I can say that those generalized questions, problem, solution, competitive differentiation, and who's your market and how are you getting it to them, and implying that as finances. Are you are you telling your audience of the solution that you have, and are you doing it at cost and hopefully highly capital efficient? The answer to one of those five, though very Dr. Seuss kind of boilerplate answer, and I don't mean to sound impersonal when I was dealing with pitches, but it's like, those are the five I'm asking. And if you fail one of these, they're not just red flags, they're an instant no. And I have to go, I have to move on again. And now you're starting to see the beast. A little bit different than the way banking, as I expressed banking, it's so regulated, it's no because of fraud, but still it's a little bit different in equity, but the same outcome. It's a no, and it's no fast. It's a
Jason.
no. Yes.
Sorry. For a guy that wasn't sure he had something to say, you're really good. You're like going and going. I want to cut you because we're going to run out of time before there's any questions or audience involvement.
Absolutely.
Okay, cool. Good stuff. No, I mean, obviously, you know the business, you have great talking points. I just want to open it up. We have some questions here. And then we can expand on things. I think Suzanne, by the way, I just want to say I worked with an angel investor group for 2 years in Washington, DC Arch Angels. So I had a lot of experience.
They're very good organization.
And I know exactly, the ups and the downs and the stuff you're talking about. I've seen it help coaching entrepreneurs, one behind me here in my company. And we can get into that, but let's start with Suzanne. I see your hand has been up. Was that first?
Hi, Jason. Yeah, this is my 5th company that I'm actually doing right now. We're doing one division, so the other ones are functional, they're doing well, but we actually are moving patient medical records from the EMRs to patients. So the patient actually owns and controls all their medical records from all the doctors, so they can take all of their data, make the hospital and the medical providers all more efficient and get surgeries and everything done quicker and more accurate, because the patient walks in with all the data. Now the office doesn't have to spend the next 2 months trying to get records from all the facilities, which is currently what happens. And so what we're looking for now is we now have great big contracts that just came to us. We're looking to automate. So we've already created an app. We now want to automate the system. So we think this is a great play to bring a VC in, because now we've got the contracts, now we've got the people. We just want to move it from, right now it's a manual process where patients have to upload their own records, to creating APIs to make things more efficient. And then using machine learning to help the doctors actually diagnose and treat patients more efficiently, because they now have access to all the records. Sound interesting?
There's just like my introduction. In fact, I have a whole half about the AI and growth and kind of the lane that you're in right now. That chasm of you've proven the concept. So I would call you past the startup. It's like, well, what do you do now when you're at that critical junction of well, we need money to scale, I assume, and that's where VC comes in. But you were face to face with, again, as I'd call the chasm between the actual startups and your scale into something very big, and implying the stated market that you're in. Which, to that, I would ask, before I'd answer any questions, particularly about your venture, is what is the value? And talk to me as I am a North Carolina layman, Marine, which means I eat crayons. So break it down into that level. And what is the value of me carrying my own data? Now, I think I understand, and correct me if I'm wrong, and correct me on both sides, but I believe I instantly understand on the enterprise side, on the company side, because the headaches that they have, you kind of alluded to it, of this data and pulling it, which again, automations will solve a lot of that in and of itself. But I'm confused, and so to outsource that, really outsource what has been their obligation to this customer data to the consumer, which is kind of a 2-win, I think, because it's letting off the market, it's letting the company off, but it's also empowering the consumer because they're controlling their data. But my question, as a devil's advocate, is what is the value of that? Because really what you just told me is, as a consumer, you're going to make me do more.
No, actually, I'm going to have you get treatment quicker, but it actually is the doctors can actually diagnose you better with the more data they have. So Correct. When you go into a doctor's office right now, they want you to fill out a form to tell you all of their illnesses, all of their things. No patient knows anything. Plus the fact that if a patient writes down that they're not diabetic, we find out later from medical
So
records
right now, is the customer, I think what I'm misunderstanding, I think I totally misunderstood then. I'm not actually carrying this. information in, Emma. I'm not like each doctor I want to go to. I'm not carrying like a hard drive with me, like a Bitcoin external.
No, that's what
It's
the military
almost like
does.
it is.
Yeah,
I
that's
just
what the
have the
military does
password.
now. Ours is actually putting everything into one place, so we can actually use machine learning to say, doctor, now when this patient comes in to see you, we're going to give you basically the answer. They're hypertensive, they're diabetic, they have all these issues.
So this
Now
is like a cloud plate. It's like cloud applied to like
it's cloud, but it's on an app. So we have a patent on being the only one that's actually doing a licensed product that patients own their own records. When the EMRs were built back in 2008, all the EMR for all the hospitals are built on one tax ID or one MPI.
So all I have to do is share my like we're doing right now in Zoom. I just share access to this Zoom room, but I don't have to do anything. I didn't have to do.
You don't have to, right? So what we're trying to do is automate. Right now we have where patients have to upload their own PDF into the app, which is like, okay, that's fine. But as we've talked to other companies, they're like, especially hospitals, they're like, if you could actually do an API, that means as every patient leaves the hospital, they automatically get their records. Well, we just eliminated half the expense of a hospital because now the business office doesn't have to do faxing out to all of these millions of places. The patient has their data. Now that patient can go, okay, now I'm going to go to physical therapy. Here's my notes. I can give my notes to the physical therapist. They know where the implant was put, what the implant is, what treatments do I need to actually get my shoulder going again. Like all of that data is at their fingertips. That's what EMRs were supposed to do, but they never built it that way. So we're building now that solution. Like I said, we own the patent on it and literally making everything automatic.
How are you? How is your progress with like what kind of feedback are you getting from the enterprise companies of like access? Again, you described something amazing, and like that access, because I could give a firsthand example. If you don't make me have to upload the PDF, and as you go, as you could, I think there's a theme coming in my defense here, and it's that I'm lazy. Whether it's you want me to bring in the data to the doctor, which is not the case here, but we cleared that up, or it's again, the less you make me do, the better. But at what, how willing are they, or how, I don't think that's the right way to phrase that. How are these companies, like these healthcare providers, willing to allow you to access to their database so it could be automated? So again, as soon as I leave the doctor appointment, I have already signed the rights and said, yes, your company can, download all the cookies on my computer so that therefore, when I leave, my record will be uploaded automatically. And if you're getting yeses from that, you have I'm sensing a huge uptick only because in a different vertical, exact same scenario. I'm in finance, but this is healthcare. But as soon as we automated the banking, like we did, I mentioned e-commerce, one of those examples, we have to upload their bank. And essentially what we created at first was a software that would just read your deposits, because I think credit and a lot of the finance is outdated because it's still looking backwards. You could have a great credit score, doesn't tell me you're going to pay my bill tomorrow. But what I think is great as a financier is your deposits. Show me that you have deposits. Well, guess what? Just send me your bank account, which in this case is synonymous with you saying the health record. But so I was telling clients, just send me your bank statements for 3, 6, 12, and I can look at it and I can see, look, you've got 10,000 coming in every day. Well, I'll give you a loan based on that, or I'll give you, because again, I think deposits are way better than credit. But
we're
still have a
trying
problem
to get
there.
Right there, our app we're just now releasing, so we've really released it only to family, friends, and others, because we're like, test it, see if you like it. Then I went to all my doctors and said, hey, when I walk in and I can show you from my genetic test what medications I can take, they're like, great, I don't want your genetic test in my system. I can't put it into my EMR. I just want to know what can I order. So if you can walk in and show me that, now at the end of as you leave the office, they can say, let me look at your screen. Okay, great. Here's the medications I can order for you. Now the patient is involved, but what we're trying to do is actually get the knowledge level of the doctors. And that's where, like I said, we've just signed a big contract with a big group that Charles works with on the Christian Share group and on a bunch of other things where we're going to now have thousands of patients. And now's the time to go to my programmer and say, now I want you to write the API. And he goes, okay, that's great. We need X amount of programmers to get this done. But now in 2 months, everything's automated. Right now, we're still doing the manual approach where people, it's the same thing. You still get your records, you still get your imaging, you still upload it. It makes things quicker for patients, makes things more accurate for doctors, makes the entire process run better.
So if I see the future right, and then I'll get to the conclusion of what I think of the business now that I think I have an elementary understanding. So where you're at is kind of what I've described, where I was at, again, different verticals. but exact same application that we're talking about what we're doing to our industries. Where we went to next, and I cannot tell you the growth that happened on account of this, as you will, where you're at this stage 2. When we did automate through us, obviously finance, it was through companies like Plaid that create the automation. Essentially, the clients give me the right to have access to the bank myself. So it's like, I don't need you to upload. I just need you to get Plaid and authenticate me, and I can go in and see it myself. The amount, our deal flow, especially like e-commerce companies that, they're online, it's like, and I want to back up and say that again, those e-commerce companies were great at when we were able to offer them funding directly and say, hey, all I need is your bank account, but it still was a barrier to entry to make them upload the bank statement.
Right.
When we automated the whole thing, got an API again, and obviously Plaid was the pioneer. We've worked with some more then, and the whole thing's automated. So now all you have to do is say, I want funding, I want 25 grand. Click here, Plaid authorizes, and instantly my software is going in and saying, look at all the, again, through the machine learning, different vertical, exact thing. Here's what they make. Here's how much they spend. Jason, you can give them this, and I can do that answer in 30 seconds. Because all the real crux is, I think, if that's where you're at, just in an industry that is just as large as finance and just as much room for opportunity, then you are well positioned. I don't want to be too optimistic, though, in the sense that you are at that chasm. You're at a real stage you need growth. Like you're facing real tangible growth, it sounds like, the opportunity thereof. And I assume
we've been trying for 2 years, just so you know, we've been modeling it for 2 years, going to all the different providers, going to everyone and saying, and half of them are like, oh my gosh, I would give my right arm for this, because right now we don't even get it from the patients, right? And I was like, I don't want the patients to fill out a form every time they come. I want them to walk in and send you the form ahead of time with all their stuff in it. Now, when they walk in, instead of spending 15 minutes looking at it, say, actually, I know what's wrong with you. I know what's going to go on with you. Let's get your vitals. Let's see where you are. Now I can treat you more accurately and give you the right information to get you to move forward in the next thing. Plus the fact that since we have a marketplace, we can start selling things directly to patients for what they need based on diagnostic.
Depending on the technology you're speaking of creating, is beyond the individual APIs that you could use, you kind of position for kind of a vertical, if you will. This is, you become like the Plaid because you are the one authenticating. So maybe even if they weren't using your marketplace, you could still create the platform because you're already creating the infrastructure. That authentication between the players that come after you still comes by way of your platform.
Right.
It's like, again, kind of the Plaid equivalent.
That's the big change. And up until, and we built the whole thing. We've got the app working. We've got everything done. We've got hundreds of people that have used it. People are like, oh, we love this. This is great. I can carry all my stuff with me. We're actually doing some stuff right now with grants with the military, because once again, they want patients to be combat ready within an hour of, so all of those things are working. All we need right now is a little bit to help us get over the hump. But we'd love to work with someone who has foresight, who's already done it in the finance world, that can actually duplicate it in the medical world.
Absolutely. I'd love to talk to you. You have my attention.
Yeah.
That's definitely.
Okay.
Yeah, I was going to say, guys, continue that definitely afterwards, contact information, and we'll have your information, Jason, also. Charlie, you're up.
Real quick, in chat, I just put an invitation to join my monthly NHF Zoom tomorrow at noon Eastern. Whether RFK can make America healthy again against these huge interests that we're trying to disrupt in this show today with Jason's advice, and I'll defer actually to Jim as for another case study with his pavilion, and maybe Peggy with her early developmental advisory and healing practice. So I'll defer. Thank you.
Okay, then let's go to Peggy.
Thanks, Charles. Thanks, Jason, for your presentation. I have a small business, but I wouldn't consider myself an entrepreneur. And my personal credit is crap because I went through a divorce. But I have this business that I think is really has potential to grow. 1 in 6 kids in the United States has developmental delays. I work with kids that have developmental delays. I've thought about starting a certification program for hearing imbalance therapists, because a lot of PTs, OTs, audiologists, that's actually my profession, do not know how to spot the red flags of kids that are exhibiting developmental delays. So anyway, my question to you, you touched briefly, like apply for credit and pay it in 3 months, and then you go to another tier to borrow money.
That's business. I was speaking directly there about business credit and just show how most businesses aren't aware, even the best even financial astute people aren't aware of business credit in itself. And it's actually a very simple process. You don't have to give any pitch to and I really should preface that business credit, what I'm really bringing out, even though it's not my main bread and butter, but I love the product as a financing tool. And again, coming from where I came from, is again 0% interest. It is not automatic. It is not automatic in the sense that you need to have an EIN. You need to have a business bank account. That business bank account, now, depending on who you're going through for underwriting, it can be 3, 6 months, 12 months that they're going to look at. But again, it goes as little as 3 months. You get tier 1 vendors. These are EIN vendors that, and again, a lot of them can sell supplies. Some of them do digital marketing, but you're looking for tier 1 vendors. And tier 1 vendors are EIN vendors. And what makes them tier 1 is they accept your business just off the EIN. You don't put your social security.
When you say a tier 1 vendor, you mean a lender, a person that would lend me money. Is that what you're saying?
No. Legally, and I did clarification. And it's only because I can't explain but it is very convoluted. No, it's not lending at all. It is you have a relationship with a particular vendor. Say in your business, you buy computers. So instead of buying the computers on a loan or credit or equity funding or cash, what you do is you go to Microsoft. Microsoft is not a tier 1 vendor, but I want to point out what a tier 1 actually is and what they're doing with the relationship of money. You're going to them and saying, I'm going to buy computers from you. But instead of me paying you cash or credit or car or anything right now, what I want you to do is net, and most often the terms in tier 1 are net 30. You can get net 45, you can get net 60. But the point legally, financially, of what we're looking at here is your relationship with Microsoft. Microsoft is saying, okay, all right, give me your EIN and I will bill you for these computers. Now, you still have limits. It's not like you can go just all of a sudden buy a Corvette and pay for it 30 days later. But the term is net 30. They'll say, we'll send you the invoice in 30 days. And in 30 days, you pay it. And now the thing about tier 1, you have to pay that invoice full. Most net 1, because again, they didn't check your personal credit. They didn't really check much other than you have it. So again, it's very strict on the back end, but it's very lenient in that you basically get 30 days. It's like a 30-day extension or grant, if you will, of money for. It's like, I'm gonna buy these computers, or I'm gonna buy. A lot of the tier 1 vendors do supplies, like a lot of the big companies. There's about 30 of them that I would pay attention to, and there's a more important detail in this, and that's that not all vendors report to the business credit bureaus. Unlike personal, which is automated, regulated, and everything you've done, it's not to business. So therefore, if you go work with a vendor, say you work, and to the point, you could work, anybody could be a vendor. But they turn around and tell the business credit bureaus, namely Duns and Bradstreet, that's the hard one. The hard one meaning there's very few that report to it. And there's 3 credit bureaus, Equifax, TransUnion, and Duns and Bradstreet, that all give a score of business credit, and that way it works like personal. But not everyone reports. So it's like, even if you got that, so I'm making this more complicated. Say you got laptops from Microsoft and you told them, hey, I'm going to pay you net 30. We're going to work out that is technically tier 1.
Okay.
But at the end of 30 days, you pay and they don't report.
How do you find a vendor that reports? And then I have
now that is the information that is buried online, and it took me a very long. And like I just said, if you heard the word to the wise, in 14 years, I've got a list of about 30 that will report, and I don't think any of them are really. I mean, not all of them will report to all 3. Now, what you're really wanting here is 3 months. 3 months of tier 1 vendor report. So, and a lot of supplies, and I don't care what business you're in, you could use supplies. I don't care if you're ordering ink cartridges or if you're doing, some of them do digital marketing services, but a lot do supplies. So let's just say you order toilet paper 1 month from this vendor and you net 30 it, and you do that 3 months in a row. Well, there is one. Now, who do they report to? Do they report to all 3 bureaus, or do they report to just one? Now, see, this is where it gets even more complicated, but it's like, first off, do they report that transaction that you actually paid? Because
Is
that's
there
what
a
we want. We're
minimum
trying to build
amount of-
business credit.
Is there a minimum amount of money for those 3 months? And you can buy,
That depends on the vendor. Like some of them you have to have $100 minimum purchase. Some don't. Some have, like each vendor has their, because again, at the end of the day, it's the vendor that's setting it's between you and them. And essentially you're saying there's a new term in finance for consumer finance. It's called buy now, pay later. Well, that's not innovative. That's just what I'm describing business credit, tier one, specifically how it works, just modeled and framed different, just modeled for consumers. But you basically get something and pay for it later, most likely 30 days. You do that 3 times with 3 vendors, you will go on to tier 2, rinse and repeat. Now, when I say the tiers, you're getting higher different financial institutions. Like tier 1 vendors might be, again, supply companies, digital marketing. I have a list of about 30 I can share with you after this. And again, which reporting agency you want. What you want is three good trade line, 3 good accounts paid for 3 months. So that's 3, you paid this toilet paper and it reports, let's assume it reports to all 3. You did that 3 months, there's 1 account. Now, if you do those 3 times, again, to all 3 agencies, by the time 3 months rolls around, you automatically move to tier 2. Now, what is tier 2? And when I'm really describing tier 2, you're moving up in what these financing, like instead the net 30 goes out the window. Now you're getting in traditional revolving lines and you're getting in, maybe lower tier finance companies. And whereas like tier 3 and tier 4 would be like your banks and actual credit cards. But it's just the quality of like Amazon, Walmart, those would be your tier 3s and tier 4s. Those are large institutions that, again, it's really just straight line financing, but you're getting revolving lines. Again, whereas tier 1, you're getting that net 30, pay it 3 times, you automatically qualify for tier 2, do the exact same, rinse and repeat, 3 vendors, 3 months. Now you've got 6 to 9 good accounts on your business profile. Now your business with its EIN can walk into Wells Fargo and get a 0% interest. I shouldn't give hard numbers since this is going on the internet, but in my experience, between 50 to 250,000, 0% credit lines from anywhere between 12 months and 24 months. Now that's a large window, but the point you need to hear is 6 months from inception. And I did not describe anything about a market. I did not describe anything about, your demand. I did not describe if you were a good business. I did not describe your personal credit. I described building business credit, which is essentially makes your personal credit irrelevant.
okay, thank you very much. I appreciate that.
I hope that makes sense.
Yeah.
You understand fire hosing and get it first go than I do. It would have taken me 6 times, and even as I'm saying it.
I don't know about that, but I've learned a lot about credit in the last 4 years. So it's to just have the idea that I can build my business credit separate from my personal credit.
Absolutely.
Is very
absolutely worth the vein to go
useful
down.
Information. Thank you.
Thank you. Okay, Jason, so we're actually coming up to the top of the hour. This thing you see behind me, the pavilion startup, I could tell you more. I have my own production company in DC. Good track record of a lot of things. Anyway, and we were about to build this in Washington, in the area. We had the local government behind us. We had a whole team of people. It's kind of a Epcot Center or a mall of well-being, but bringing forth all the best of what we're not being told. The next generation of living free and smart, and the Great Awakening, exactly. But then COVID came and hit us, so everything stopped. And I've just been waiting it out till a new administration, et cetera, and see how the things go. So now we're kind of getting back in gear. There's a lot to discuss. So maybe this is a conversation I could track you down. We could have it later because I don't have a simple question. But I had 2 feasibility. We had feasibility studies, business plan. I came out of Cornell, graduate, like business school, hotel school, all over the world, contacts. WTS International at the time put this cash flow of between 500 million and $1 billion on 20 properties. And I mean, it looked okay. It looked good, decent anyway. They said this is a sustainable project. We like it. And we'll invest in it also once you get your first investor, for example. So we were getting rolling, and then we got shut down. In the process, I've lost a few people because of everything that's happened in the last few years. So now we're kicking up again. So this might be and you mentioned Corvette, so I know I like you. we can talk about that. I'm a car motorcycle guy. But yeah, so why don't you, in the meantime, tell people how to reach you, tell our audience, what's the best way to reach you, follow you on social media, and so on.
My easiest and most is the most unprofessional answer I can give you. I have so many professional handles and brands, whether it's moonshine or fintechs and, investing. But the fastest way is just my name, and don't rely on my enunciation, because in my Southeastern American vernacular, aka the Southern accent, I speak in cursive, but it is my name at Gmail, which is Jason Feimster, Feimster. See, that's with that accent. But find my name, whether it's in this, and just put it at Gmail and send it to me, and that will come. That is actually the only email that will come to my phone, and I monitor. Not necessarily professionally, but every other email is monitored by someone else before it actually gets to me. It's screened. So the most direct, personal, intimate. That's just Jason Feimster at Gmail. Old fashioned. Send me an email or shoot me a text. I'm a millennial. I like to text. In fact, in a lot of ways, I went full circle. I'm not necessarily divorced from email, but we may be going through a separation in that, and I'm not necessarily speaking of my personal Gmail, which I don't really give out to like an internet like this, but in this sense, it calls for it. A text, which is just the 202-643-2022. A lot of 2s and 7s in that, but send me a text and say, hey, I'd like to pitch, or some kind of headline. I saw you on this call. I'm watching later. Send a text there. You might talk to my bot at first. Maybe if you send a text, and if you email, there may be a bot to do some exchanges. But if not, those are the fastest way to get a hold of me with any way, shape, or form. Whether you've got a real estate deal, whether you've got a cutting edge deep space deal, whatever you want. Those are the two. Just email and phone.